You know how in structural engineering, there's this concept of resonance. Like you can build this massive suspension bridge, right?
Yeah.
And it's designed to withstand a huge earthquake or, Category 5 hurricane.
Yeah.
Tons of just sheer physical force.
Right, yeah, it's built for impact.
Exactly. But if the wind happens to hit the structure at like exactly its natural frequency, the whole thing just changes.
Yeah, it creates this, well, it's a self-reinforcing feedback loop. The vibrations just amplify and compound, and eventually the steel literally tears itself apart from the inside.
Yes. The structure defeats itself because of its own underlying mechanics. And honestly, looking at global markets this morning, it feels like we've hit a resonance frequency.
Oh, absolutely.
Like we are watching real-world kinetic warfare feed directly into automated market structures, and the resulting feedback loop is just tearing the order books apart. So we are unpacking a massive volatile convergence happening right now. It is April 6, 2026.
And it is a messy one today.
It really is. The goal of this deep dive is to map the exact translation between global shockwaves and, immediate on-chain realities. And for those listening, we are skipping the basics today. We're looking at the latest market data, the kinetic escalation in the Middle East, and some very aggressive corporate and regulatory maneuvers that all kind of collided within hours of each other.
Yeah, the timing is what makes this so unprecedented.
Right. So, okay, let's unpack this. Starting with the market's explosive morning.
Yeah.
If you were looking at the charts over the weekend, the baseline sat around, 66,833 thras?
Yeah, roughly. It looked relatively stable, all things considered.
Right, stable. But then we saw this intraday peak just absolutely shatter resistance. It drove the price all the way up to $70,271 before settling back down near $69,500. And this was decidedly not organic retail buying.
No, not all.
Centralized exchanges processed, $255 million in derivative liquidations, with shorts making up roughly 73% of that bloodbath.
Yeah, and that 73%, that's the key metric here. It tells us we are looking at a textbook algorithmic short squeeze.
Right.
But the catalyst is what makes this morning's price action so unusual and, frankly, a bit disconnected from reality.
How so?
Well, going into the weekend, the order books were incredibly heavy with short positions. Human traders and their models were pricing in further downside just based on the obvious regional instability in the Middle East.
Which makes sense.
Right, it makes logical sense. But those models were completely upended by the sudden introduction of a diplomatic headline, the Islamabad Accord.
Okay, right. Which is a draft ceasefire proposal originating from Pakistan, Egypt, and Turkey.
Mm-hmm.
And the specifics of that draft are, they're incredibly ambitious. We're talking about a phased execution. Phase 1 proposes a 45-day cessation of hostilities.
Yep.
And immediately reopening the Strait of Hormuz, which is obviously a massive global energy and shipping choke point.
Exactly, a huge economic relief valve.
Right. And then Phase 2 opens up a 15 to 20-day window for a broader permanent settlement. And the concessions required are steep. Like Iran would have to entirely abandon its nuclear weapons development.
Which is a massive ask.
Massive. And in exchange, the United States has to authorize immediate sanctions relief and unfreeze sovereign assets.
And see, the market didn't treat this as just, idle back-channel chatter. Because the communications matrix on this framework is highly visible.
What do you mean?
Well, Pakistan's Army Chief, Asim Munir, has been directly communicating with U.S. Vice President J.D. Vance, Steve Witkoff, and Iranian Foreign Minister Abbas Araqi. So the moment the headlines regarding this specific framework hit the newswires, automated algorithmic risk engines across global exchanges just began scraping that data.
Oh, okay. The bots.
Exactly, the bots. They use natural language processing to read words like ceasefire or Islamabad Accord and Strait of Hormuz reopening, and they instantly assign a massive positive sentiment score to the market.
Okay, wait. Hold on. I am genuinely lost here.
Yeah.
How can these bots trigger a multi-million-dollar buy wall based on a draft document when the physical infrastructure in the Middle East is literally on fire right now?
I know, it sounds counterintuitive.
Aren't these algorithmic trading engines supposed to be highly sophisticated? It feels like we're looking at a thermostat that's hooked up to a news feed instead of a thermometer. Like it's automatically blasting the air conditioning because it read the word winter, even though the house is actively burning down.
That is exactly it. That is the fundamental flaw in sentiment scraping models. They lack physical context.
So they don't know what's actually happening on the ground.
Right. The algorithmic risk engines don't comprehend geopolitical nuance or physical destruction. They only execute the structural mechanics of their programming. When those bots scraped the positive sentiment from the ceasefire headlines, they immediately began aggressively bidding up the price.
Which creates a huge problem for the shorts.
Exactly. That sudden upward price action triggered margin calls for all those human traders who were heavily shorting the market over the weekend.
Right? Which creates the feedback loop. So if I'm shorting the asset and the algorithm pushes the price above my liquidation point, the exchange's margin engine forces me to mechanically purchase spot Bitcoin.
Yep, forced buying.
Just to cover my underwater position. So my forced buying pushes the price even higher, which liquidates the next guy, forcing him to buy, and so on.
Precisely. It becomes a cascade. So to address your skepticism earlier, no, the bots are not genuinely pricing in peace.
Right.
They are just executing a structural mechanic that creates an artificial price floor. If you look closely at the data behind that 70,271 one-all peak, there is an absolute lack of actual bid-side depth.
So it's basically a hollow rally.
Completely hollow. The algorithmic models reacted to a diplomatic framework while completely ignoring the kinetic reality playing out simultaneously.
And that kinetic reality is severe. Because despite the headlines about the Islamabad Accord, the United States actually issued a hard deadline for Tuesday at 8:00 p.m. Eastern Time for strikes against Iranian power plants and bridges.
Yeah.
And allied forces didn't even wait for the deadline.
No, they didn't. The destruction of physical infrastructure over the last 24 hours has been staggering. Allied strikes targeted the South Pars petrochemical complex in As-Saluya.
Which is huge.
It's massive. For context, that single facility produces 50% of Iran's entire petrochemical output.
Wow, 50%.
Half of it, yeah. And between this specific strike and prior engagements, 85% of Iranian export capacity has been removed from the board.
That is just... I mean, that's devastating.
It is. We are talking about the severing of critical utility infrastructure that supplies electricity, water, and oxygen to these industrial zones.
And it's not just infrastructure either. The kinetic escalation includes highly targeted assassinations. Airstrikes in Tehran killed Major General Majid Kademi.
Right, the head of the IRGC intelligence organization.
Exactly. And they also eliminated Yazdan Mir, the commander of Quds Force Unit 840.
Yeah.
I mean, these are decapitation strikes on military intelligence.
And the retaliation was immediate, which further proves how disconnected the market's algorithmic optimism is from the facts on the ground.
All right, the bots don't care about ballistic missiles.
Exactly. Ballistic missiles and cluster munitions were launched into Tel Aviv and Haifa. But crucially, the IRGC also claimed a direct strike on a United States amphibious assault ship, the LHA-7.
Wait, really? A U.S. ship?
Yeah. The physical reality is that a U.S. naval vessel has been forced to retreat into the southern Indian Ocean.
So the algorithms essentially built this fragile $70,000 tower based on a draft PDF?
Yep.
Completely disconnected from the reality of burning petrochemical plants and retreating naval vessels.
And that's the danger of the current market structure. If that Tuesday 8:00 p.m. U.S. ultimatum passes without formal Iranian agreement to the ceasefire terms, the resulting military escalation could instantly shatter this artificial algorithmic bump.
Because the bots will read the negative headline.
Exactly. Once the bots scrape the headlines of a failed negotiation, the sentiment flips, the forced buying stops, and the asset could plunge right back down to that $66,000 baseline almost instantly.
Okay, so here's where it gets really interesting. Because while the algorithmic bots are blindly panic buying based on diplomatic headlines, we are seeing intentional, calculated accumulation happening behind the scenes.
Oh, absolutely.
Like we have two completely different entities who are quietly, or maybe not so quietly, securing block space, utterly, regardless of the geopolitical chaos.
Yeah, the contrast is fascinating.
Let's look at how accumulation is happening at the absolute extremes of the network. On the macro end, we have Strategy Inc. Between April 1st and April 5, they absorbed a massive amount of selling pressure coming from legacy miners. They acquired 4,871 Bitcoin, deploying $329.9 million at an average execution price of $67,718.
Which is just a huge amount of capital. And that brings their total corporate treasury to a staggering 666,970 Bitcoin.
Incredible.
And if you look at their aggregate cost basis, they are sitting at $58.02 billion, averaging $75,644 per asset.
But help me understand the mechanics of this, because the irony of their strategy is just blowing my mind right now. Strategy Inc. is utilizing something called at-the-market offerings.
Right, ATM offerings.
Yeah. They are essentially leveraging traditional fiat equity markets to absorb decentralized supply. But they are doing this while simultaneously sitting on a $14.46 billion unrealized loss for the first quarter of 2026.
Yeah, the paper losses are huge.
Right. So how do they keep hitting the buy button when they're down $14 billion on paper? Most funds would be facing catastrophic margin calls.
Well, it comes down to the architecture of their capitalization. An at-the-market, or ATM offering, allows a publicly traded company to issue and sell new shares of its own stock directly into the secondary trading market.
At current prices, right?
Right, at current prevailing prices. So they aren't borrowing money from a bank that can issue a margin call. They are selling shares to traditional finance investors who actually want exposure to their corporate strategy.
Oh, I see.
So they take that newly raised fiat liquidity and instantly convert it into block space. Their $14 billion paper loss doesn't trigger forced liquidations because they aren't utilizing highly leveraged short-term debt to buy the asset. Oh, wow. So they don't have the same pressure.
Exactly. They are operating on a completely different time horizon. Strategy Inc. isn't trying to trade the geopolitical volatility of the Middle East. They are trying to permanently remove supply from the secondary market as a long-term duration play against fiat debasement.
So you have this corporate leviathan using the mechanisms of Wall Street to hoover up billions of dollars of the asset.
Right.
But then on the exact opposite end of the spectrum, we have a solo miner, someone operating on the CK pool service with just 230 terahashes per second, and they successfully validated block 943,411.
Which is amazing. To put 230 terahashes into perspective, for those who don't track mining hardware, that is a minuscule amount of compute power in today's industrial landscape.
Like, what do we talk? A warehouse?
No.
Yeah.
It's essentially a single older generation machine plugged into a wall.
Right. Literally just one machine. And they were up against a crushing aggregate network difficulty of 138.97 trillion.
Yeah, the math is just staggering. For this solo miner to find the specific cryptographic hash that validated the block, they had to beat odds of roughly 1 in 28,000.
Yeah.
It's mathematically profound, but statistically, it's just insane. Yet they did it, and they walked away with a 3.139 BTC reward, which is roughly $210,000.
And you know, the contrast between Strategy Inc. and that solo miner perfectly illustrates the underlying architecture of the protocol.
How so?
Well, the network is entirely mathematically impartial. It doesn't discriminate based on capital allocation. It perfectly facilitates the integration of traditional finance, allowing a multi-billion-dollar corporate giant to leverage traditional equity markets to build a treasury.
Right, it doesn't block them out.
Exactly. But simultaneously, the cryptography doesn't care if you have $58 billion deployed or just the single ASIC humming in your garage. The decentralized consensus mechanism hasn't closed its doors to the individual.
That impartiality of the code is such a stark contrast to what we're seeing humans do this morning.
Oh, for sure.
Because the moment you step out of the protocol and into the real world, human regulators are actively deciding who gets access to this asset class.
Yeah, the regulatory divergence is wild right now.
It really is. We are seeing a massive geographic divergence in regulatory approaches, effectively laying down institutional red carpets in one country while throwing up retail roadblocks in another. Let's look at the U.S. first.
Okay.
Morgan Stanley is launching a new ETF, and they are setting the annual fee at 0.14%. That is the lowest fee vehicle in the U.S. market right now. Why are they racing to the bottom like this?
It's an aggressive loss leader strategy.
A loss leader.
Yeah. By slashing the cover charge to 0.14%, Morgan Stanley is signaling that they view this asset as a permanent fixture in wealth generation. See, in the traditional wealth management sector, the most valuable metric isn't the immediate fee revenue.
Right. It's the AUM.
Exactly. The assets under management. Traditional finance institutions know that once client capital is onboarded into their ecosystem, it tends to be incredibly sticky.
People don't like to move their money around.
Right. They are willing to take a near zero margin on the ETF itself just to capture that capital from high net worth clients and lock it into their broader management infrastructure.
So Wall Street is aggressively paving the on-ramp. But if you cross the Atlantic, regulators are actively ripping up the road.
They really are.
On April 6th, the UK's HM Revenue and Customs HMRC quietly reclassified cryptocurrency exchange traded notes, or CETNs. They essentially evicted these assets from standard tax-advantaged stocks and shares ISAs.
Which is a huge blow to retail.
Huge. And for anyone unfamiliar with the UK system, an IOSA is an individual savings account that shields everyday retail investors from capital gains taxes. But HMRC forcefully redesignated crypto ETNs into a highly obscure category called Innovative Finance ISAs, or IFISAs.
And, the bureaucratic friction this creates is entirely intentional.
Oh, completely.
While investors who held positions prior to April 6 are grandfathered in, meaning they don't face forced taxable liquidations, the practical infrastructure for new investments under this rule simply does not exist.
Right, because major brokerage platforms like Hargreaves Lansdowne, AJ Bell, and Nutmeg are outright refusing to build the back-end infrastructure for IFISIS.
Which makes sense from their perspective.
It does. You can't really blame them. It requires entirely new compliance, reporting, and software architecture for a very specific niche asset class. Trading 212 responded by simply disabling the buy button for CETNs entirely. They just shut it off.
Wow. Which really highlights how modern state control operates. The mechanical outcome of this policy is profound. Because the brokers refuse to build the tax-advantaged wrappers, UK retail investors are forced to utilize general investment accounts for any new accumulation.
Which means taxes.
Exactly. That completely strips away their tax-advantaged status and subjects their investments directly to capital gains levies.
It feels exactly like a VIP club dynamic. Wall Street is rolling out the red carpet, handing out 0.14% cover charges for wealthy clients to waltz in the front door, while UK regulators are quietly chaining the side door shut for retail investors using bureaucratic tax codes. They aren't making it illegal for the average person to own. They're just making it structurally exhausting and prohibitively expensive.
Yeah, and it shifts the entire paradigm of how sovereign nations handle decentralized networks. Historically, the fear was the outright ban, but bans are clumsy.
And hard to enforce.
Very hard. They are difficult to enforce and often just drive capital and innovation offshore. What we are seeing in the UK is a pivot to subtle structural exclusion.
Through paperwork.
Yes. By weaponizing the tax code and leveraging bureaucratic compliance, regulators can achieve the effects of a ban without ever passing a law making the asset illegal. It forces us to ask a critical question about the future of ownership.
Which is?
Will your access to this asset class be defined by cryptographic self-custody, holding your own keys, or will it be entirely dictated by the friction of your geographic tax jurisdiction?
That's a sobering thought. So what does this all mean? We started this deep dive looking at a market reacting to diplomatic tripwires. We saw an algorithmic short squeeze artificially pump the price to $70,000 based on the Islamabad Accord, while actual kinetic strikes simultaneously destroyed 85% of Iran's export capacity.
Yeah, a complete disconnect.
Exactly. We watched Strategy Inc. utilize at-the-market offerings to aggressively accumulate thousands of coins despite a $14 billion paper loss, all while a solo miner mathematically beat astronomical odds to validate a block.
The extremes of the network.
Right. And finally, we tracked Morgan Stanley dropping ETF fees to capture wealth management capital, just as UK regulators weaponize their tax wrappers against everyday retail buyers. It is an incredibly dense, contradictory web of human incentives colliding with automated systems.
It is. And actually, there is one final critical thread connecting the geopolitical data in the Middle East to the traditional finance data on Wall Street that the market hasn't fully priced in yet.
Hold that.
Well, if you dig deeply into the text of the Islamabad Accord, embedded within the concessions are Iran's demands for transit fees from global shipping entities passing through the newly reopened Strait of Hormuz.
Okay. Transit fees.
Right. But crucially, they are categorizing these fees diplomatically as war reparations.
Wait, they want to establish a literal toll booth on one of the most vital energy and shipping choke points on the planet.
Precisely. And if that toll is enacted as part of the ceasefire, it introduces immediate, unavoidable supply-side inflation to the global economy. Every barrel of oil, every container of manufactured goods passing through that strait becomes instantly more expensive.
And that cost just gets passed down.
Exactly, passed directly to the consumer. Now, connect that geopolitical reality to Morgan Stanley rolling out the cheapest ETF in the U.S. market. As traditional wealth managers onboard client capital into these funds, how will they model this asset?
Man, that is the ultimate question. If inflation spikes because of these transit tolls, will Wall Street view the asset as the ultimate hedge against a new, geographically enforced supply-side inflation?
Right. Or, because the algorithmic bots we discussed earlier have bound the asset's price action so tightly to the daily news cycle, will traditional managers look at their models and simply dump it as a risk-on tech asset the moment that exact same kinetic war causes a broader market contraction?
It goes right back to the resonance frequency of the bridge. The very geopolitical shockwave that proves the necessity of a decentralized non-sovereign asset might be the exact vibration that causes automated markets to aggressively sell it off. It's literally a structure defeating itself.
Yeah, it really is.
Well, thank you for joining us on this deep dive. Stay curious, keep questioning the models, and we'll catch you next time.